Hello, my name is Clive Corcoran and welcome to my YouTube channel, the Corcoran Codex. And I very much hope that you will decide to subscribe to this channel. There is no obligation, you don't have to pay any money to subscribe. It just allows me to stay in touch with all the various people that have shown some interest in the material that I am adding to on this channel all the time. What I want to cover in this video are certain financial instruments known as total return swaps, but I want to put this into the context of a recent financial scandal, which occurred in very recent times, and this is known as the Archegos collapse, or the collapse of this fund, Archegos, which was technically a family office, although that in many ways is very, very similar to a hedge fund. This whole episode was effectively facilitated by the use of these swaps, these total return swaps. Let me then begin essentially with the end of the story, really, which has to do with the sentencing of this gentleman here. This is Mr. Bill Hwang, who lives in New York, or I believe he's now in prison in New York. He's a South Korean gentleman, but resident of the United States for many, many years. And he had a history some years ago as the manager of a very large hedge fund known as Tiger Management. And then he went out and set up his own fund, or family office as it's known, which was called Archegos. And as you can see here from the article in the New York Times, he was convicted back in July of 24 for his role in the collapse of this firm Archegos that caused roughly $10 billion in losses for several Wall Street banks. So let's have a look at another article here from earlier on. This is in April 2022, and this article is from the Wall Street Journal, and basically it talks about federal prosecutors who discovered this scheme and then eventually took Mr. Hwang and his CFO, or former CFO, through the courts, and which resulted in the sentence that you saw on the previous slide. So Mr. Hwang and the CFO were indicted on securities fraud and racketeering charges in connection with a massive fraud and manipulation scheme that, according to the WSJ, nearly jeopardized the US financial system. That may be a slight exaggeration there. So Archegos collapsed in March of 21, leaving banks with more than 10 billion in losses and sparking calls for more regulatory oversight. More than $100 billion in stock market value vanished in a matter of days, which we'll come on and look at. So you can see here the U.S. Attorney for the Southern District of New York described the scheme as a historic in scope, alleging that defendants and their co-conspirators lied to banks to obtain billions of dollars in loans, which they then used to inflate the stock price of publicly traded companies. And just to continue for a moment, Mr. Hwang's use of these swaps, the total return swaps, allowed him to manipulate prices of stocks in his portfolio because the agreement prompted Wall Street firms to buy shares of the stocks that he wanted them to hold, and this was alleged in the indictment. As the size of the swaps grew, so did the amount of shares bought by Wall Street firms, pushing up prices in the process. And the prosecutors alleged that Archegos traded at certain times of day and in other manipulative ways to prop up stocks in its portfolio, including those to keep share prices from falling too much. So let's have a look at the actual investment vehicle or financial instruments that were used in this. Now, over here, let's say this is Archegos, the hedge fund or family office. And now it turned out that Mr. Hwang had cultivated relationships with a number of large Wall Street investment banks over here. They were aware, they had dealt with Mr. Hwang because of his previous, as I said, management of this large hedge fund, Tiger Management. The key to understanding really what went wrong in this particular episode is that the structure per se is not necessarily that risky, but if, as was the case, Mr. Hwang was involving a number of large investment banks and their prime brokerage function without informing them that he was in fact dealing with several banks, their competitors effectively, without telling them that, letting them think in effect that he was dealing with just them, then that obviously was what gave rise to the allegations, the indictment, and then the eventual jail sentence that we looked at. So let's just basically explain how this total return swap works. Now, what Archegos then wanted the bank to do, bear in mind there were a number of banks, but I'm just going to talk about one bank for the moment. He went to the bank and said, look, I'd like you to buy, well, let's use the numbers on the screen, $10 billion worth of exposure to a number of, say, US companies, buy the equities of a number of US companies. And he would then select those equities. They agreed that they would buy positions in these companies and hold them on their own balance sheet, the balance sheet of the investment bank. And what would then happen is that they would ask Mr. Hwang to put up some margin effectively, or collateral. Now the diagram shows that this is actually 1 billion against 10, so 10%. I'm not entirely sure that was the actual arrangement that Hwang had with the banks, but for the moment let's assume that is roughly what it was. So Archegos would then deposit in cash $1 billion to the account of the investment bank. The bank would buy the stocks, and then what would happen on a daily mark-to-market basis is that, let's supposing on the positive side, the shares of these companies kept moving higher. Now that would be good news, because eventually, let's say when the swap expires, there would be a term to the swap, the Archegos could ask the bank to liquidate the portfolio, and any gains would then be transferred over to Archegos. On the other hand, of course, if the exposures or if the shares in the portfolio started to drop in value, which of course is eventually what did happen, then the bank would call for more margin, more collateral, full collateralization of the losses as and when they arose. And as I said, the bank would have been confident enough to enter the arrangement with Mr. Hwang, believing that Archegos had sufficient funds to collateralize any losses. There were, of course, considerable fees being paid by Archegos to the bank for entering into this arrangement. And as I've said, if there were losses to the shares in the portfolio, then Archegos would be 100% liable for them, would have to cover them through a series of margin calls that the bank would make against Archegos. Now, as I've indicated, the real problem with this arrangement was that when he was dealing with each of the banks that he dealt with, and they included JP Morgan, Goldman Sachs, and the banks over here, and he did not inform them that he was in fact dealing with several banks. As I indicated before, each of the banks, the prime brokerage function in each of these banks, believed that he was dealing with just them. Now, with the smarter banks that he was dealing with, and I'll just cite maybe JP Morgan, Goldman, and so on in that category, when the portfolio that he had asked them to buy with these various companies, when that portfolio started to take on losses, the banks like JPM and so on liquidated the portfolio right away, which is what they were allowed to do, and they could still come after Archegos to cover any of their losses. But how shall I put this politely? Some of the less smart banks did not liquidate immediately and decided to hang in there, hoping maybe that the price of these companies' shares would actually eventually move upwards, which of course many of them did not. Now, the company which lost the most in this whole episode was Credit Suisse. And as we now know, Credit Suisse did not survive. But eventually Credit Suisse did throw in the towel, as it were, and lost $5.5 billion. Mr. Hwang wasn't around to cover that. So that was, in fact, an actual serious loss to the bank. And as I've said, many other losses which eventually led to the collapse of Credit Suisse. Nomura, a big Japanese investment bank, also lost the best part of $3 billion. Morgan Stanley, big American investment bank, $1 billion. UBS, another Swiss bank, $1 billion, and so on. You can see them over here. So let's just read what the New York Times has to say here. So using these swaps, the total return swaps, allowed Mr. Hwang to avoid publicly reporting his exposure to the stocks. He, in fact, wasn't actually holding them in either his own name or the name of Archegos. They were actually being held by the various banks. While the swaps provided anonymity to Archegos, the disclosure that big banks were loading up on these shares was a signal to the markets that a big client was probably behind the purchase. And as indicated before, Mr. Hwang had worked at Tiger Management, a very large hedge fund that had had dealings with a number of these banks previously. That's why, in a sense, they were confident to deal with him. However, in 2012, he was prosecuted based on an insider trading investigation, and securities regulators said that his own fund at that time that he was managing, Tiger Asia, had used confidential information to bet against shares of Chinese stocks, and he was in fact fined $40+ million as a result of that. Now, what is actually particularly interesting in the case of Credit Suisse is that the people at head office of Credit Suisse in Zurich, Switzerland, in fact is the office, knew about this and actually had warned the people at the Credit Suisse branch in New York not to deal with Mr. Hwang, be very wary of dealing with him. And despite the warning that came from the people in Zurich, the prime brokerage people in New York still dealt with Mr. Hwang and Archegos, and then as we saw, they ended up losing more than $5 billion. Just to give you a sense of what did go wrong with the portfolio that these banks, these prime brokerage departments of these big banks were holding, and as can be seen here, the share price of these companies, all of them dropped precipitously. Viacom, I believe, dropped the best part of 70+% during the relevant period here in the first quarter of 2021. So I hope very much that you found that video to be of interest, and could I encourage you then to subscribe to my channel, the Corcoran Codex, where I will be adding similar material, and you can see the general theme of this YouTube channel is analyzing critical ideas and episodes in the world of finance. Thank you very much for watching.